We have Samir Arora joining in of Helios Capital all the way from Singapore with his perspective on the markets. Samir, it's great to have you this morning. Thanks very much for taking out the time. Have to start off with Bitcoin. I know it's not a theme directly linked to the markets, but the world is talking about it this morning. So, you have to give me your take.
Well, I have read my books, a few articles, and discussed with a few people, but I still don't understand it. Reason is I don't know whether the Bitcoin is being positioned as money or is it being positioned as gold. Right now, the way it is going up, it seems to be positioned as an alternative to store of value rather than a transaction value. But when it started, it was starting more for transactions, initially illegal or whatever, or confidential. And now it seems to be mixed up between these two things because the money itself cannot move at this rate. If the money is so deflationary, which means when measured in bitcoins, every day the rest of the world prices keep falling, then nobody should trade or use that as money because its value in theory is supposed to go up. So I guess now it has moved to saying that it is like gold because it is limited in quantity and if it has to be mined. So you're using words like gold. But please note that gold got its value over 5, 10,000, God knows how many thousands of years. Where you go anywhere, any place, somebody will know, everybody will accept that this is valuable. So to think that in 1 month you will have, just because you say this thing is limited in quantity, it cannot be mined beyond 21 million points, therefore it is gold. I think it's complete nonsense. But so I'm not in it.
So
Neither do I plan to be in it.
Samir, do you think like all other manias, whether it's the tulip bubble mania or the internet mania, several manias, what financial markets have seen in last couple of centuries, the Bitcoin mania will also end badly?
In the end, it will not end badly or not, I don't know, because they say there's a new line of thinking, you need young people who are willing to do all these things. But it will have to correct a lot and then be accepted by a second round of people. So if for this current round, I think it will end badly, maybe over years. Because my thinking is that gold does not come up just because it's limited in quantity. It came up over, millions of years, or not millions, thousands of years, where it held its value through wars, through depression, through flight, people running away. Everywhere you went to a new country, new place, or new area, you could use it. So to think that this will take over that just because the new crowd doesn't relate to gold, I don't believe. So I think it'll end badly. But I'm not overly going to say it because I don't even understand the whole concept yet.
Let's talk about something which you have been owning and something which you track with the magnifying glass, private banks. Post recapitalization, there is a section in the market which believes that private banks will underperform and NBFCs will struggle because the cost structure in the system will change. Do you think it's too early to draw that kind of a conclusion?
I should laugh. What a story. What a story. The point is that nothing changes. If you give money to people, they can last for 1 year, 6 months. But you have to change the whole system, the whole culture, the whole incentive, the whole firing and hiring, the whole of getting some new people in, or being able to hire the best MBAs, or being able to do new products, or being able to say that I will open on a Sunday morning, I will come to your home and collect your signed check, or I will, whatever, everything. It doesn't happen by just saying at the top, not take new money. But second thing is, who will believe it beyond a little bit? To say, okay, I will, with my next inflow, I'll buy one State Bank of India or something, by the way, we've also done. But broadly speaking, who will make a serious shift? And the new money will keep flowing. So let us say that currently people were putting 20% into private equity banks, let's say. And now they will say, no, we'll put only 17 and we'll put 3 into state-owned bank. How will it change anybody's life? You will still make adequate and more money in the private sector banks or some of the banks, and we hope that we do the same.
Right. No, sorry, are you saying something, Samir? Did I cut you off?
Tell me something that has changed in the last 15 years in any of our companies from whatever they were before. And not only state-owned companies, private companies. People have done badly because they had leverage, I understand. But otherwise, these cultural things and the way these things work don't change so much. They can outperform for a few months, but the money, because now I've done it for more than 20 years, you don't go into a market thinking that you should make the highest possible money in that market for that period or that year. If you make consistently good returns, you just compare it over 3 years, you'll have the highest return. It is not that I must today have the highest return, then tomorrow I'll have the highest return in that phase or that period. It will never happen. So broadly is going with confidence that this thing is adequate to give me very good returns relatively, and over time that will become absolutely better than others who are every day trying to maximize the return.
I'm just reading some points that you highlighted just before this interview. You're saying that you continue to be negative on pharma, telecom continues to remain sluggish, looking to short PSU banks, focus on domestic consumption stocks. Now the thing, Samir, is that these stocks have already run ahead. So do you keep your faith with these growth stories?
I don't know where you pick this up, because these are not my today's comments. These are my lifelong comments for the last many years. Pharma, telecom, we've been short for at least 5-6 years. Pharma, at least 1.5-2 years. So these are not today's comments. So please rephrase the question. This is a general motherhood statement, not forever, but for the last 1 or 2 years.
Given that we've seen a big price action on the upside in PSU banks and telecom, by and large, we know your positioning that either you've been short on them or you've been avoiding them. Have you covered your shorts here?
So in state-owned banks, we did cover, as I said, and some we didn't want to cover because they went up. So we countered by buying, as I told you, which one, little bit, although it hasn't. But after that, the next trade right now is to be on the side, other than 1 or 2 that we refused to cover. And we've got back maybe 15% out of that. And they went up maybe 30-35%. But as I said, our main game of survival is that each of the stocks that we short is very little in weightage. It's only 1.5 to 2% of the fund. So if I lose 20-30%, that means I lose 20-30 basis points or 40 basis points on that. And we are up some 40%, so who cares? But the point is that is the whole strategy, is that you cannot throw us out unless we choose to be thrown out. And we did leave a few, and we should have, because after we covered them, they are also down. So we had maybe 5% in 3 stocks, PSU banks at that time, and now maybe we are maybe 2.5-3% in 1. So it's broadly okay. The point is not, that day, obviously that particular day was bad, relatively speaking. But in general, the thing is that, look at it, anybody who believed in this strategy, like some of the biggest mutual funds of India, and they have underperformed from 3 to 4 to 5 years for 1 month of glory. I don't think that was a very good trade at any point.
I want you to talk a bit more about your view on pharma. I know it's circumspect. I know that you're wary of pharma, and I was just here reading out some of your thoughts also on how you find it really amusing to see what the analyst community has to say about these pharma names, because the background for my question is essentially that even now, from a price perspective, we keep getting queries from viewers and retail investors saying, can we buy into any of the pharma names, whether it's on Facebook or on Twitter. And the thought process there is, on any given day, you will see a DV's Lab getting a clearance or perhaps a Biocon getting an EIR for their Bangalore facility, and then simultaneously, a couple of days later, you will hear something on Lupin that, okay, they've been asked to recall their batches, or some facilities still under review. It's a mixed bag. Would you still say, just steer clear?
And our thing is, we don't like mixed bags. We like where there is a tailwind in favor of the industry or that theme, so that if we make a mistake, our mistake is only that we did not choose the best performing stock, but got by our wrong analysis, the 3rd best performing stock, but it still had massive tailwind in its favor, which, big picture has been the case in private sector banks, in NBFCs, in insurance. You could have bought the wrong one and you would still have made. You could have bought the worst one, like from a stock performance point of view, Max, which hasn't gone up even 1% this year while the whole market is up. But still you feel no problem, this will get solved because it's okay, problem being whatever. So the point is, we want that. We don't want this analysis where by mistake we bought this stock and that one got a notice and the next one actually did not get. So we think that is why we call it a gamble in a big picture sense. Once in a while, we also have a Pharma or two stocks these days, but generally speaking, first thing is that while these stocks have corrected, their valuations have not corrected because their earnings have fallen much more than the stock prices have fallen. And secondly, there is a benefit that they were getting from a very liberal US system, which allowed these obscene prices. I mean, we may say that now there is, we all know that there's a Justice Department investigation going on against many of these Indian companies. So my theory for this is that you make money for 4 years, you get a PE, 5th year you get fined more or less equal to your profit for the 4 years, and our esteemed stock market guys will say this is a one-off. So they will basically reduce it, say, theoretically from the market cap while you were going up, you had a 15-20% growth, and on that you got a multiple. And while you get fined, because right now in theory everybody is about to get fined, or many of them. And so this thing where the system has changed, where they say that we want to give more approvals, where we want to give faster approvals, where if in some generic the price hike is high or the prices are high, we will preempt we will push your application faster, and it won't be treated on first in, first out. And we will encourage you to apply in those categories, means that the macro has changed. Although the buyers also changed. Now the number of buyers in the US have consolidated. Now CVS wants to buy an insurance company, so even more consolidation on the other side. And so these things you can't resolve just because the prices fell 20%, and those prices, by the way, fell not to reduce the P to reflect the new environment, because the earnings fell. So big picture, we don't like it. If you say one stock, maybe we'll say, yeah, not so bad.
Samir, what I've always admired about you is your ability to really stay ahead of the curve. You've identified IT, you've identified, Bharti when it just went public, or for that matter, the potential of private banks, including HDFC Bank. Where do you see this kind of visibility for next 3 to 5 years, where the size of the opportunity or the size of the pond, like investors like you always say, is still very big?
No, actually that big picture opportunity set is reducing, because there were two things why so much money was made. By the way, just across my 21 years, my fund NAV is up now. If I took Alliance plus Helios, 200 times the fund. And this is after paying 2.5% management fee for 20 years. But the point is, now there are two things which don't happen. First is that we don't have completely new sectors coming up, where if you are early, you know that these are globally, sectors that normally would do well in this environment. And therefore, when they come to India, they will do well, which is what we played as one big theme. And the second is, which I totally hate from the bottom of my heart, the private equity investors, because they have come between me and a good company by sort of delaying their IPO. So in our days, we could buy Z at 50 million valuation and HDFC Bank at maybe 200-300 million valuation. Now these private equity guys don't let us buy those things. They will delay basically these companies coming to market, and therefore they take away 1 or 2% per annum from our market. So in general, if you find a good stock, of course, the returns will be high again. But in general, from a top-down basis, I think the returns for super stock selection will be lower than they were in the past, because we were playing both the roles simultaneously of being private equity stroke venture type guys, but with a little bit more comfort because the companies were listed. So at least they had been around for 3, 4, 5 years. So it was not from a complete zero. And second is that completely new themes which were obvious in the rest of the world were coming to India. So now it's a bit more difficult. But the market today we don't want to make 25, 30%. I mean, we want to make, but we don't expect to make 25, 30% returns per annum. If we can make 12, 15% returns in dollar, you can get all the money in the world, provided the market also doesn't go up more, which means we want 12, 15% return, and we also want to beat the market. It's not that the market goes up 30, I'll be happy with 12, 15. But in absolute, while going in, what I have realized is that if you go in with expectations of reasonable returns, and you make reasonable returns for a few years, at the end of it, you outperformed everybody. Because reasonable return over a number of years is very good. In any 1 year, it may look low. And we consider reasonable return as 15-18% in dollar terms.
And that would be matching the earnings profile as well. Samir, you have kind of put out your thoughts on this whole index fund investment theme. I don't want to talk about index funds per se, but the world is seeing a fair amount of interest in ETFs, which are slowly coming to India as well. I mean, we had the Bharat 22 ETF, which was well subscribed. It's a product which is not taken off in India just as yet, and I know your bias as an active fund manager, but for a retail investor, what should be the most prudent way of approaching investments here for a product which is equity linked, but relatively perhaps insulated to giving the kind of returns that investors would want?
This bias thing is very bad, because I have to say to the retail investor what I have believed all my life. I can't say for me this is good, but for you that is good. So I think that in India historically there has been massive outperformance. The outperformance of all these guys, HDFC in the olden days, and Reliance and Alliance and ENU, whatever, it's not been 2-3%. It's been 8-10% per annum for like 15-20 years for all these guys. And therefore, for me to say that now buy an index fund, I don't like. But then I see these stats which say that 47% of these guys underperformed, which then doesn't look as much fun. So who knows? I like active. I think there is still a lot of dumb money following index funds and ETFs. And I think when the markets correct a little, then active funds, those aggregate numbers will also outperform, because they will go to 5% cash, or they'll go to some HDFC Bank type stock and outperform the index. So I am not going to say, no, you buy an index fund while I am active. No, I am active, you also be active.
I'm simply curious, never seen you in a suit in a long time. So is it Singapore winter?
You guys are very lucky, because I have a big meeting in the afternoon that you have got the pleasure of me wearing a suit today.
Yeah.
All right,
you have a great meeting, Samir.
Thank you very much. Thanks again.